you're going to want to follow along on the risk calculator tab. This is at the 45 plus DTE strategy page. So if you haven't already, you're going to go to www.thetradebusters.com, go to the link for the 45 plus DTE income strategy. There's a new tab, or not new at this point, you've already seen it, but there's one called the risk calculator, and then there's one called the capital efficiency study. So let's actually look at the capital efficiency study first, because I did post a couple of new test results that I've done. So if you scroll down to around row 33 and scroll over to the right side, column O and beyond, I have a new table here. So, you guys are probably familiar with these tables from a little while ago when I first started really pushing the research. And this new table, and it's labeled, you can see that it is 15 delta. That hasn't changed for now. 60% max profit. This sort of is kind of the sweet spot we found. It's just a little bit higher, so you improve the risk reward a little bit versus the 50% max profit. And we're still exiting at 2x loss. Remember this 3x credit, which is 200% stop loss. But right now there's no DIT cutoff. All right, so we're gonna let this trade run. And the interesting thing is you'll find that the average DIT is not that much higher than where we used to have it. With the 90 DT, the 60 DT, we used to cut it off around 24, and you can see that the average days in trade is really only about 26 for the 90 DTE. And this test runs from 2005 through 2020. Right? If you see the tables from before on the left-hand side and on the earlier longitudinal studies, you see that some of my tests were 2016 to 2020 only, which is 5 years. This is a 15-year, or was it 16-year? The reason we did this is because I saw that the test from just 2016 and on, and you'll see this in a longitudinal study, the win rate was very consistently high. So it was kind of skewing everything and making the premium capture rate look higher. It just made everything look better. So this last 5 years was particularly favorable. And then looking at the 2005 through 2020 results seems to be, I guess, kind of more realistic. Obviously, all of this is with the benefit of hindsight, and who's to know what's going to happen in the future. But anyways, I just want to let you know those are the assumptions, so you can kind of gauge for yourself which direction you want to go. So right now, I only have the three DTEs on here, the 60, 90, 120. So you can see that the win rate is pretty similar, right? It's all wrapped around 86, 87%. Average win size is around 0.6 because, of course, we're using 60% max profit. And because we're not having a cutoff here, right, every single exit is going to be the stop or a profit target, which is why you see that 0.6 for the average win. Average loss is just above 2. That's probably because of gaps. So that raises it. That's why it's not perfectly 2. So risk reward is about the same. And obviously, the main differentiation is the average DIT. Okay, so 60 DT has 18.3, 90 DT has 26.4, and 120 has 35.6, which translates, of course, to the average book size. And again, average book size, if you enter every day, and we're going to look in a second that you can actually change this, but if you do enter every day, as I mentioned before, you take the average days in trade, divide by 7 for a number of weeks, and multiply by 5, which is because you can only put on 5 trades a week, right? And of course, in a previous episode, I've talked about this idea of the credit ratio, the BPR ratio, value at risk, capture rate. So you can go back to the previous episodes to catch up on those metrics, and of course the capital efficiency ratio. But I want to mention a lot of this stuff with the capital efficiency ratio honestly is not that big of a deal anymore, especially if you're going to be using a bomb shelter. Because putting on the bomb shelter, if you have the portfolio margin or using futures, it drastically cuts down the BPR. So right now, for example, we're doing the 90 DTE short and 60 DTE long. The total package as a percent of notional versus the short strike is somewhere like 2%, right? So it's extremely leverage that you can get. All right. So again, that is why we really want to use the credit as a proxy for risk. But this risk calculator is really going to give you an idea of what exactly where this value at risk comes from. So remember, value at risk is my way of measuring kind of how much premium you have on the table at any one time, because the premium dictates your potential loss because we're taking double that, right? So right now, before we flip over to the risk calculator, just note that this in this table, Y37, right, cell Y37, value at risk for the 90 DTE, or 60% max profit, 0.27%. And we're going to see this number come up. Hopefully, you'll finally have a really good understanding of what that means, okay, the 0.27% value at risk. So let's go ahead and flip to the risk calculator. And again, this is interactive and dynamic. Again, so the orange cells are inputs you can do. Now, just kind of walk through real quick. So the account parameters, NetLick is obviously very simple. You can set whatever account size you want. And the target return, this is the target return per year, okay? So for now, I'm going to set it to 1%. Just so this is assuming I only want to make a percent per year. Okay, so there's an entries per week, pretty obvious. So if you do, let's just set it at 5. We can look at what happens if you reduce that in a second. But if I have 5 entries per week, so I'm gonna use $1 million for the net liquidity, 1% target per year, entries per week is 5, and then moving down we have the strategy assumptions. For now the delta is gonna be 15. Now there's a toggle for the bomb shelter which can be on or off. I'm gonna turn it off for a second, but I'll explain what that does later. PCR is the premium capture rate. Now this, you're going to want to take that from whatever study or whatever configuration that you're doing for this trade, okay? So if we flip over to the capital efficient study for a second, the 90 DTE 60% max profit, this had a PCR of 27. So I'm going to go ahead and put in 27% for a second. Average days in trade, go back to the table, is 26.4. Okay, so I'm using the same inputs from that particular part of the table, okay? So the 90 DTE 60% max profit with no DIT cap is 27% PCR and average days in trade 26.4. With those inputs, the rest of the table, all of that is automatically generated. Okay, so these are very straightforward. Moving under the average DIT, you'll see entries per year. This is very simple. It's number of entries per week from above times 52 because there's 52 weeks in a year. So in this case right now it's 260. And then the average book size is that same formula from before. We take the average days in trade divided by 7. And we multiply it by entries per week, right? Before I've always multiplied it by 5 because that was the entries per week if you enter every day. So right now I made the formula generic. I just multiplied it by that before, which is the input cell. And we'll see how that affects what's effective once we reduce that. But for now, I just want to set this example before we tinker with it too much. So average book size is 18.9. You can see that matches the average book size from the capital efficiency study tab. So what does that do for you? All of that filters down to your credit target per entry for your trade. Okay, so if you have $1 million and we're trying to make 1% per year, you can see that the PL per year, or the profit we're trying to make, is $10,000, which is 1% of $1 million. And because in this setup the PCR is 27%, you can see in the formula it takes the profit that we want and we divide by the PCR, right? So 10,000 divided by 27% gives us $37,037, because that's how much premium you have to sell per year in order to make 10,000 if you're capturing 27%. So this should all be very familiar, right? We've talked about this in the credit targeting episodes and a lot of the sizing episodes, but now you hopefully have something visual to see right in front of you, all right? And so finally, that all translates to credit per entry. If you look at the formula, it's the premium per year divided by B13, which is the number of entries per year, right? Premium sold per year divided by entries per year equals credit target per entry, right? And credit target per entry in this case, in this particular setup right now, I'm looking at $142, meaning you sell whatever product will give you that $142 for the short strike at 15 delta at the DTE that you're entering. So if we're entering 90 DTE, we're going to go to 90 DTE, and whichever product, MES, SPY, ES, SPX, will give you that credit target for each short strike. Okay, now you can of course adjust the number of contracts. Now, the way I've set it up right now, this is a very small credit target. Obviously, if you have a larger one, you can scale up and down the number of contracts, or vice versa. And we'll get into the scaling in a bit. But I want to look at now the table up top, which is the value at risk. Okay, so you'll see where the 0.27% now is. So I have the first row, which is average book, which is just the average book size. That's purely taken from the stats earlier. But I know that because in practice, your book size can change. It can go higher, it can go lower. I have sort of 5 arbitrary book sizes here. I have just 10, 20, 30, 40, and 50. So that's just at a glance. Now let's look at this value at risk. F2. This is right now E2, which is the average book size, times B19. B19 is the credit per entry. Okay, so remember, our credit per entry with this current setup is $142, and if we have an average book size of 18.9, we have $2,686 of credit on the books on average. And if we take that credit and divide by the net lick, which is B2, this is the one you set, we get 0.27%. So now we finally see where this 0.27% comes from, right? I have said before, for every 1% target return, this is the amount of credit you will have on the books. And you can finally see from the net lick, from the target return, from the number of entries, everything filters down and translates to this value at risk. Now that's just the credit on the books. What's your actual risk? Well, I have something called a level 1 book wipe risk, which is just basically losing the whole book at a normal 2x loss. So you can see in H2, this is simply value at risk times 2. So instead of 0.27, I think this rounds, it's something like, let me add another decimal place here. It is 0.54. So if you have 0.27% of value at risk and you lose the book, you will lose 0.54%. And now we have level 2 next to a nuke risk, which I've said, I have sort of a disclaimer on the right hand side that I'm using a 2x loss to evaluate level 1 book wipe risk. And I'm using 7x loss as the nuke risk if you have the bomb shelter, and if you don't have it, it's 15. You can click and see the formula. It's sort of an if statement. If B10 is, if it is on, it uses 7x, and if it doesn't, it uses 15. Again, this is from, if you listen to the hedge episode, this is based on TOS analysis. So these are simulated based on 20% down, VIX 80. So take it with a grain of salt, but this is sort of the best approximation I can come up with. Okay, so right now with no bomb shelter on, it's 15x. So rather than 0.54%, it's a 4x drawdown. Okay, now that doesn't seem very big. That's because I've only set the target return at 1%. So I'm going to just flip this. Now, obviously, you probably want to make more than 1%. So let's just say I wanted to make 15%. Okay, so I'm going to change the target return to 15%. All of the numbers will pretty much increase, but you should now kind of understand where we're coming from. Everything just 15x bigger, right? So at 15% target, still 5 entries a week, same PCR, same average days in trade, same number of trades per year, book size is 18.9. But now, rather than $10,000, my PL per year target is $150,000. Premium sold required is $555,000, and then credit target per entry is now $2,000, right? So everything is the same sort of setup. It's just now scaled bigger. And so at a 15% target return, now my value at risk on average is 4%. So level 1 book wipe risk is 8%. And the nuke risk is now 60, right? Now that's clearly much too big now. This is why we can look at the bomb shelter and see what that does, okay? So you can now see how everything kind of translates. And depending on the configuration you're trading, you can size up until you feel comfortable with the various the level 1 and the level 2 risk, and you can gauge the book size, right? Because remember, there's average, but then you can look at, hey, what if it was 30 entries? Or what if it did get to 40 entries? Because remember, we're not capping it, but you always have the discretion to prune the book, right? Let's say you're okay with 30 entries, but you're not okay with 40. So you can start pruning if you start getting close to that, right? So let's turn on the bomb shelter toggle here. And all that's going to do is it's going to assume a nuke risk of 7x, but it's going to also automatically increase your credit target by 20%. So you can see in the premium per year formula, which is on B18, it says if B10 is on, or bomb shelter on, basically multiply by 1.2. And this goes back to, I mentioned in the last episode, using the bomb shelter will cost you about 20% of your profit. So you need to leverage up by about 20% to get to the same level of return, right? So this is kind of baked in for you. So right now I'm going to, again, I'm going to have the $1 million net lick. I'm going to leave the target return at 15%. Entries per week is 5. I'll turn on the bomb shelter. PCR average guarantee doesn't change, but right now you can see that the credit per entry goes from 21.37 to 25.64, right? So I need to sell more premium. So that increases all of the value at risk by a little bit. The book wipe risk goes up, but the nuke risk, again, I mentioned in the formula, I'm using 7x if you have the bomb shelter in place. So with 15% target, average book size 4.8%, value at risk, level 1 book wipe risk is 9.67, and then the nuke risk is 34. So again, 34% seems high, but again, if you think that a actual nuke risk 20% gap, all that craziness is even possible, maybe losing 34% is reasonable, especially that's like a true black swan. And rather, you're not going to get wiped out. You're just, and again, that's sort of an extreme circumstance, but it's another way for you to gauge, like, hey, what am I actually comfortable with in terms of sizing this up? Because again, the BP at this point, right, even targeting 15% return, if you're using the bomb shelter, you may very well only be using 20%, if that, of your capital, right? So clearly, if you're using 40%, 50%, it's going to be humongous, right? So you can no longer use buying power really as a gauge of your risk. You want to use something like this risk calculator with the credit targeting to get a good idea. So a couple quick things before we wrap up. This idea of the entry target, okay? If you wanted to sell a larger product, or if your account was so small you couldn't sort of fit any of the products to your credit target, you can artificially boost the size of the trades without sizing up the risk, so to speak. And I'll show you what I mean. So right now with this configuration, which is the $1 million, 15% return, 5 entries per week, you can see that the credit target we just mentioned is $2,500. Now, let's say you're in between where, SPY is something like, let's say SPY is $5,000 or SPX is $5,000 for that 15 delta. And you want to sell SPX, and you don't want to sell SPY for whatever reason. So the credit target of 2,500 is too little, right? But that's because I'm entering every single day, right? So if I decrease the entries per week, I'm going to change it to 4. Credit target goes to 3,200. If I change the entries per week to 3, credit target goes to 4,200. Now I change the entries to 2, 6,400. So I kind of jumped the gun a little bit, but the reason is you can use this as one more degree of freedom to tailor the trade, is because for the same return target and the same PCR, it obviously makes sense that if I want to capture X amount of premium, but I'm only selling, 3 times a week, 2 times a week, as opposed to every week, I have fewer entries, right? And you'll see that in the strategy assumptions, the entries per year goes down because I'm only doing twice a week, and the average book size go down, right? And then the total premium I need to sell per year doesn't change, but because I have fewer entries, the credit I need to sell per entry goes up, right? So again, that's just what I mean by if you purposely sell less per week, less frequency, you can sort of increase the target that you need per entry and still size the trade the same from a overall risk level. And if you play around the calculator, you'll see what I mean, because as you fiddle with the entries per week, you'll see that the average book size and the average value at risk doesn't change. It just changes the amount of entries that you have. But since you have more credit per entry, they all kind of balance out. So again, you'll see what I mean when you play around with that. And the last thing I kind of want to mention is with the PCR, because that's such a fundamental driver of the credit that you're targeting, it's the whole system is very sensitive to this. And if you look at all the various back tests, let's go back to the capital efficiency study for a second. Looking at and again, this is the table over on the right side in column O, about halfway down, row 33. Looking at the 60, 90, and the 120 DTE, and back to why we chose 90, these win rates are very similar, okay? And the premium capture on this table just happens to look a little higher for the 90 DTE, and that's purely because the win rate was like 1% higher. Honestly, you want to take these with a grain of salt because, again, these are back tests, right? And things can clearly be different moving forward. And if you look at the longitudinal study, the win rate, sometimes it's all over the place. It's really high in one year and really low in the other. This is a long-term average. So for all intents and purposes, we're almost treating these as if they're similar. And the main reason we want to do the 90 DTE is just because the average days in trade is shorter. So your average book size is shorter. The trade-off is because with the 90 DTE short, your long is at 60 DTE, and this is again for the bomb shelter, it is a